Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. Also, let's look at the company today which will be in focus, but I'll give you some hints and you should guess this company, what this company is all about. The company manufactures clean air products. So there is a hint to that also because the name is there in that. Also, the company is of course a recently listed stock. The history is less, but it will be very interesting to know the outlook going ahead. It's trading more than 19% above its IPO price. Another hint, it had a very good listing pop. And the company in focus is today Tenneco Clean Air products. This company is having of course an MNC parentage, but nevertheless we will be asking important questions is why the street is not giving any valuation premium for an MNC auto company. That's the biggest question we need to ask the management, and also through my analysis I'll get you the answers. The margins are still worrying the street. Is it the higher royalty payments going ahead, or the change in product mix not in favor of company? Will the after service become the next frontier? After sales services is very much important when you are dealing in this kind of a business. Is export potential being capped by the product design or the core areas which they are shifting in? These are the questions we'll be asking, and what are the company's real risk triggers and how will company mitigate them? That is something we'll be watching out for, and any bold product expansion moves ahead. Because more and more product categories go, there's more inflection point and more chances of re-rating. And of course, the company is at a discount to its peers as well. So these are the important questions which has led me to question the management and research as well. But before we start our research on the company, I'd like to give you some more details about the company, what it does actually and what are the key products. It of course is an auto ancillary company. In that space itself, it has having an MNC parentage. It's a part of Tenneco Group. So there is of course we can see a strong DNA coming, especially in a tech and an R&D setup. Also, it's a US headquartered and a key global tier 1 automotive component supplier. As the company's name suggests, it's clean air. So they manufacture highly engineered, tech intensive clean air products and solutions going ahead. And also they manufacture powertrain and suspension solutions. This is largely which the analyst community thinks that this is a commoditized business, and we will understand more as we delve deep into the company. These are tailored products for Indian OEMs and the export market as well. Looking at the aftermarket primarily, that they are doing through Motocare. That means they don't have anything in-house. They have a different partner who is doing the aftermarket services. So if a company gets their in-house aftermarket services, especially an auto ancillary, then their margins and operational efficiencies also improve. Also, this is the entire details for the company we have given you for Tenneco Clean Air. But our format of KYC is that we give 8 rating parameters depending on the sector and the stock. First one is of course the income statement, balance sheet, cash flow, return ratios. The key numbers, they need to be checked in first, how the trends looking like, and the shareholding, street cred, the valuations, especially with its peers, which I'll be comparing in the MNC space, and the outlook. So totally we are having 8 of these parameters where we will judge the company. So let's go one by one for all the rating parameters which would be in our focus. The first one is the income statement. That's something which you'll be watching out for, and we will be giving you the details about this income statement. And the revenue over here, the large numbers here in FY24, it was 5,467 crore, and now my concern starts coming in. Out here is just 4,890 crore rupees. So there has been a kind of an impact, and this might be from the global business as well as exports of most of the auto ancillary players were on the lower side. Interestingly, the EBITDA has remained flat, but the margins has seen a jump. Now, will this margin sustain going ahead? That's a very big question to ask. And the net profit here, that has seemingly done well. So top line growth, not so much, but the bottom line growth has been significant. And that is why we are actually kind of giving a neutral rating when it comes to the income statement. Let's go to the second important rating, that is your balance sheet. And largely we see the equity base has gone up, but borrowings, that's become nil. So that's what I liked about it. But this company, the way it is functioning, it has a support from its parent company, which is an international company, and the cash bank balance, that has actually significantly gone up as well. As around 286 odd crore rupees. Not much to read right now when you see these balance sheets. So right now I'll give you this company a neutral rating. So we have spoken about two parameters right now. First is of course the income statement, the second being the balance sheet. let's look at the cash flow ratings, how it actually pans out. And let's see the third rating comes in the operating cash flows. That has significantly jumped up, and this is what I liked, 1122 odd crore rupees coming in. So that actually helps the working capital ratios for a company when you ever do this analysis. The net cash flows, that is still erratic, I would say, but still in the positive, but lower than the FY25 numbers. These are the H1 FY26 numbers, by the way. Just is 6 months worth of data. So if this continues trend, this might be 160 crore operating cash flow at the end of FY26. So that's what most of the analysts or the investors will be hoping for the company. It's a very short period. The company was recently listed, so we need to give it time for the company. And for that reason, I'll be giving just a neutral rating when it comes to the cash flow segment. So 3 important categories I have spoken about. The fourth category, that one is going to be the return ratios, and the return ratios have been going up each year. The ROC, the return on capital employed ratio, generally for this industry it should be more than 20 odd %, but the company has delivered, and it is a sustained delivery happening. So that's what I really liked about it. Around 34% was there in FY23. So a lot of product changes do happen, and a fund raise, fund infusions also happen. A strong parental lineage is there, and that is why I feel this might be one of the top numbers for the return ratios in the ROC segment for Tenneco. So it will be a thumbs up, the first thumbs up actually coming in our show for this segment. That is your return ratios. So we have spoken about totally 4 of these ratings. We are in the middle of our analysis. Let's go on to our 5th rating procedure, which would be in focus, and that's the shareholding part. You must be wondering that only one line is there for the analysis, but because the company was recently listed, that's why there is no history of it. And I just like to point out the promoters are having 75% stake, and that's a recent numbers coming in post the IPO. 4% coming for FIs, and DI is also 10 odd %. That means they are respecting the parentage, the MNC impact, and it's a kind of a safe bet. There might not be much volatility in the counter, and the time period is very less. DI is 10% stake, FIs are holding roughly 4% stake. So it's evenly balanced, I would say. Only 10% odd is there in the retail. On that basis, I'll still give a neutral rating. I want to wait it out and see how this actually shareholding pattern changes over the next few quarters as well. Up next from that is street cred. I had mentioned you and given you in the tease itself that it's up 19% from the IPO price, but there was already a big listing pop, and that listing pop was more than 20%. So from the listing price also, if you look at it, the stock hasn't performed yet. It's just a very short period. It came in November itself. It's still down 7%. There are some market conditions also. So that's why it's not fair to judge the company and give a thumbs down. So I would be giving a neutral rating when it comes to the street cred. I would like to wait and watch. But the question remains is, the biggest thing why I'm getting this company in KYC for you, for all the analysts who have written to us, and also the Gen Zs and all have spoken about this company, is the valuations front. Why is it not trading at premium valuations compared to the larger auto MNC players? Your answer might be there in some of the work in the outlook and what the management is going to say. Tenneco Clean Air, they're trading at 30 times its FY27 P numbers. Compare that with Bosch, compare that with Schaeffler. They are having bigger names, but they're on the higher side when it comes to the valuations. ZF Commercial, that's 52 times the valuations. The only one which is cheaper is CIA Automotive. That is 16x the valuations which are coming in. Now, there are 2 reasons I'd like to explain you. The first one is there are a lot of issues on the product competition. The parentage is definitely there, but Street is not giving even the average premium for an MNC auto component supplier. CIA Automotive is an exception because of their product mix as well, and that's why we are seeing a big correction and a difference coming in. So that's why I will be giving a strong thumbs down when it comes to the valuations. It's likely to remain in discount the way the perception or the strategy of the company is looking like. That's what the broking houses have stated. So 7 ratings are done. Let's move on to the last but not the least. It's very much important. That's the outlook segment. They are expected to benefit from BS4 to BS6 structural change. That's largely known and factored in, and during the IPO itself also we heard it from the company. But my concerns are starting to come. There is a lack of aftermarkets. That's a concern coming in. They are doing it through a third party. And also exports, they may remain a challenge because of there's a Trump tariff issues which are there. And till now, we haven't got our US-India trade deal completion. That might impact their export business. The margins are likely to have peaked as per brokerages. 2 important reasons for it. Change in product mix which is there, And that's where the question comes. And also the royalty payment, which the Indian company gives to the foreign arm, that itself might be an area of concern, at least from an investor point of view. That's something which we'll be also asking the management, that what will happen for the overall margins going ahead. But of course, let's take a entire review of all the ratings which we have given. If you look at the financial numbers, nothing much there happening. Some divergence are there. So net, it's a neutral thing coming in for the first three parameters. Return ratios was very much a very strong improvement coming in. Shareholding, street cred, let's give it more time before we judge this company. But I'm still concerned when it comes to the valuations and the outlook for the industry and the company as well. So net, I'll be giving this company around 3.5 out of 8 in the KYC rating setup. And largely, this is on the lower side at an average when we get a company in our show. So of course, we will be looking at this company, but now management, Arvind Chandrasekharan, he's the CEO of Tenneco Clean Air. He will be joining us. We are now joined by Arvind Chandrasekhar. He's the whole-time director and the CEO of Tenneco Clean Air. A very good afternoon to you, Arvind. Just looking at this newly listed company, and it was very interesting for me, and because I was doing a lot of valuation check with your MNC peers as well, and some kind of discount is still there. But that question will be something else. Just wanted to get it out, what are your actual products, because we have spoken about the clean air products. That itself is a big ecosystem. But just for the benefit of our viewers, if you could just start with the product portfolio and on the revenue breakup as well, what is Tenneco Clean Air all about?
Right. First of all, Sharad, thank you for having me. Really appreciate it. Yeah, so we're Tenneco. At the group level, we're a $17 billion company. We're a massive automotive tier one supplier. We have 180 plants, over 30 countries, 40 tech centers. So we are basically a R&D technology company. We have access to 5,000 patents, which you can imagine from an India standpoint is such a gift, because we can directly take tried and proven solutions from Europe, US, or even Tenneco China to India to support our Indian customers. So I think that's a huge benefit. So as you asked, to answer your question, we have clean air products, powertrain products, and advanced suspension, or we call ride technologies products. And
go ahead.
Oh, sorry, I thought I lost the connection. Yeah, so we have what we call CAPT, so clean air powertrain, that's 50%, and the advanced ride technologies, that's another 50%. So it's a very good combination of engine and chassis products, and so it forms a natural edge for us from the standpoint of electrification, etc. So those are the two, let's say, product portfolios that we have.
Arvind, can you just give me a detailed margin breakup for both of these key products which are there, and also the blended consolidated margins which currently the company is sitting at?
So we've not reported specific margins for the business units, but overall, we're running, last year we ran at about 18.6% EBITDA. This time, you can see for H1, what we reported is a healthy 19+% EBITDA. So you could say that Clean Air is a few hundred basis points better, and advanced ride technologies is 200 basis points lower. But it shouldn't matter, because over time, what is happening is the advanced ride technologies business is slowly becoming more and more premiumized, okay? Because we've got excellent tailwinds of premiumization as the shock absorbers are going from conventional to frequency dependent to more active suspension, and that automatically means the number of competitors we have is very few, and therefore the margins are higher. So over time, it's going to be nicely balanced. So that's one of the reasons why we think the margins can be sustained. That regardless of how things move, we have a natural hedge, and as we acquire more and more businesses, the absorption will be better. And you saw the order book that we've reported in the Q2 press release, which is also very, very healthy. So based on all of that, we think that we will have very sustainable and good margins and growing margins over the next 3 years.
And Arvind, there are some street concerns also, especially when it comes to the royalty payment hike, because this is how an MNCs work, and you're an R&D firm. You just mentioned that you have around 5,000 plus IPs as well. Also, the change in product mix, that's something which the brokerages have actually raised some concerns. Will that actually dent your margins outlook going ahead, or is that covered?
Okay, so there are two questions in here. So first of all, a royalty, right? So what we pay is 2.5%, which is middle of the fairway when it comes to royalties. If you look at other multinationals, there are some that have royalties of 4 or 5%. So we're at 2.5%. I think that's a very small price to pay considering how far we've gotten. If you go back the last 5, 6, whatever, 7 years pre-COVID to now, we've completely displaced the competition in some areas. Like uh, during the BS4 days, we had 17 competitors. Look at now, we just have one or two competitors, right? The same thing on the shock absorber side. So we've slowly crept up market share, and this is only because of the technology and the R&D capability and the strength of our local R&D and the applications engineering team. And that wouldn't have happened if it wasn't for all these patents. So 2.5% royalty is a small price to pay. As far as your other question on the product mix, we don't have to worry about margin dilution or deterioration. Why? One is we have enough content per vehicle additions on both the clean air side and the suspension side. Because remember, we got all this legislation happening, right? You got CAFE 3 for CO2 happening. We got TREM 5 for tractors. We have also BS6 to BS7. And the last 6, 7 years pre-COVID to now, we've gained so much market share. So in the commercial truck, for example, we're at 57 to 60%. Shock absorbers, we were 48 even during the filing of the DRHP, and now look at us, we're from 48, we've gone to 52% on shock absorbers. And also on off-highway, on clean air, we are at 68%. So we're starting to be a very strong force in the market, and I wouldn't say domination, but we are very, very strong. And because of the unique relationships we share with our customers, we feel that they are willing to work with us as a trusted partner. Again, that is our purpose, is to have customers believe that we are the trusted partners for them. So I think from a margin standpoint, we will sustain these margins as long as there's growth. There's a lot of growth in domestic business. There's a lot of growth with exports, right? Export possibilities are not just Tenneco India to third-party OEMs, Tenneco India also to Tenneco Europe, Tenneco the US, mostly Tenneco Europe, you would say. And there, by the way, exports, the margins are much, much better. So one thing is happening, right? Our exports are growing much faster than the regular business, right? Regular domestic business. And the export margins are also coming in much nicer than domestic margins. So we think that combination, and by the way, it covers clean air, powertrain, and also suspension, right? So we're exporting all of these products equally to
Spoke
our
about the exports front. I'll get back to you on that. But there's another question which our audience has asked, and that is regarding the after-service segment. Largely, when we look at an MNC, especially in the auto segment, they generally have their own after-service segment. But right now, I think it's a third-party Moto Care, if I'm not mistaken. If I'm mistaken, please correct me. Uh, so this after-service segment, are you looking at developing an in-house product? Because if that happens, a lot of benefits and operational efficiencies kick in, and that the trust factor also comes in, and that's very much important in a market like India. So I wanted to get your view on this after-services segment. This might not be a very big one, but it's very much required for an auto player.
Yeah, see, look, we decided strategically to not be a player, at least for our kind of business, right? If you look at our products, right, this sheer size of our products are pretty big. The exhaust systems are large, even shock absorbers and suspensions. As we get into future technology, these products are built for life. So they are not like brake pads or products that require frequent replacement. And second thing is, we don't really need aftermarket revenues and margins to shore up our lack of margins elsewhere. We are making excellent margins. As you just see our number, 18, 19% EBITDAs are, some of the best numbers in the auto sector. And like we said, a strategic decision to be an OEM player, but there's enough volume and business growth to be had, business to business, right, from us to third-party OEM, and of course, also back to Tenneco entities. So we decided to focus our efforts in this area, and aftermarket is going to be a much smaller area for growth for us. And the margins for us are being a technology player and R&D player, and that's where we're going to make all our future margins, and it's sustainable.
Yes, technology and R&D player, that's what you're positioning your company for the markets, for Dalal Street. But I want to know something much more about your exports. You spoke about there's a huge market for it, but the entire auto sector, or at least the auto ancillary space, has been under, a big pressure, especially with, non-completion of US-India trade deal. demand is very volatile even in Europe markets. What will be your view on this? You can give a both company as well as industry perspective on that.
Yeah. So I think things that are happening in the US, I think you have to discount because we don't know where it's going to land. The 50% tariffs, they're talking about it landing somewhere at 18 or whatever. So that's an ongoing negotiation. As far as we are concerned, the bulk of our exports are to Europe, whether it's third party or to even Tenneco entities. One of the reasons that our exports are going to be strong and sustainable is because a lot of our order booking on export is coming from just booking business with our own sister entities in Tenneco Europe. So whether it be selling them raw material or part of the bill of material for what they need to be competitive, or sub assemblies, or even finished product, right? Tenneco
Yeah,
India has
yeah,
this
Arvind,
labor
I
cost.
just need to ask one question.
Right.
Just give me a breakup with how much your business you're doing with the export with your sister entities with the group level. So then the audience will understand, how much risk you are actually exposed to or actually are not exposed to. So give me that
Right.
breakup.
So I'd say if you look at our future order book, right, I think that's the right way to say it, because in the future, because right now our exports overall are only 5% of sales, right? We started off with a very low base because export was never a focus for Tenneco for the longest time. It's only now that we've created exports to be a big area for growth. And already in the last press release, we said that, and what we've uploaded to the SEBI website, we've said that we've already up to about 8%. So in the future, if you look at our order book, in the 1,760 crores of order book, 70% of that is just exporting back to Tenneco entities. These could be semi-finished goods, or like examples like rods and sintered parts, or even finished products, right? So there the margins are coming out nicer. And again, it's a good thing, right, when you're just exporting back to other Tenneco entities. So I think our risk on export is much, much lower than any other company because of this growth potential. Remember, the rest of Tenneco, beyond us in India, Tenneco Clean Air being $500 million business, the rest of Tenneco is a $17 billion entity. So a lot of labor cost arbitrage is possible. We can also, for example, consolidate product, bring that to India, especially where there's low capacity utilization in Europe or the US. So all of that business is a target market for us. And again, not only do we benefit because our growth improves, but at the Tenneco Group level, it also benefits the Tenneco Group and our ultimate promoter.
All right. Thanks a lot, Arvind, for answering all our important queries. I know I played a devil's advocate today, but it was necessary for the company to be discovered amongst investors and people as well. Thank you very much for your candor and time for NDTV Profit. Thank you. Well, that was the management of Tenneco Clean Air, cleaning a lot of concerns which were there regarding the stock. So that's something which we'll be looking out for. But that's all for today at NDTV Profits KYC. Stay tuned.